And I want to thank everybody again for joining us for our webinar today, which will be on residence trusts with your hosts, Maureen Lester and Mark Munson. Just a reminder that if you have any questions during the presentation, you may type them into the questions tab on the GoToWebinar dashboard. A copy of the presentation materials is also available on the dashboard as well. Maureen is an elder law attorney for complete estate and probate law, and she practices in the states of Missouri and Kansas. Mark is a certified elder law attorney for Reuter Ware and practices in the state of Wisconsin. So without further ado, I'm going to go ahead and turn it over to Mark and Maureen, and hopefully everybody enjoy.
Thank you, Stuart. Welcome, everybody. We're really glad to have you with us today, and we hope that you get a lot out of our presentation today. As you can see, the title is called Deep Dive into Residence Trusts. So we're going to make a few assumptions that you know the basics of the irrevocable trusts. We're going to go over that really briefly. If our first slide is confusing or goes too quickly for you, then after this presentation, you may want to go back and review some of the basics about irrevocable trusts that may or may not hold a residence. So let's jump right in and get into context. So what we are going to be talking about today are primarily irrevocable trusts that are meant to preserve certain assets. And because this is called a residence trust presentation, we're going to assume that the asset preservation trust is preserving a piece of real estate of some kind. So that's the context in which we're going to talk about. However, even if it's not a residence, if it's some other kind of asset that needs protection or preservation, or is not a residence but has some other income producing component to it, this is still going to be really relevant and go into some of those detailed nuances that you'll need to know when you are creating these kinds of trusts. So generally, a irrevocable preservation trust is going to be just that, irrevocable. So it's going to start out as an irrevocable trust. You'll have some choices whether you wish to make it a non-grantor trust versus a grantor trust. We're going to get into quite a bit of that later on in the presentation, because that's typically talking about taxes. And so there's going to be two different types of taxes that we are weighing here when we determine, is it going to be a non-grantor trust versus grantor trust. Generally, we're thinking about, is the tax going to flow through to the grantor, and what type of tax is going to flow through the grantor, or is it not going to flow through to the grantor and it will instead be taxed within the trust at the trust tax rates. Of course, the primary intention for these kinds of things is to protect assets from being subject perhaps to Medicaid look back. And sometimes you will just create one of these to protect from estate recovery. So for example, I'm working with a client, she is roughly 81, and she just got married for, it's a second marriage for her, but she just recently got married, and her spouse is also in his upper 80s. So she wants to she has pretty substantial assets, and she has a long-term care insurance policy that lasts for her lifetime. She knows that she's never going to get on Medicaid, but because she just got married and her spouse has less significant assets than her and no long-term care insurance, she actually just created an irrevocable asset preservation trust just to protect from his potential Medicaid and his potential estate recovery. So sometimes you do that for that estate recovery risk that's coming from externally. The whole purpose of using these is so that when Medicaid looks at this whole situation, they see that the applicant for Medicaid has given up control of the assets. So at the time that you make this transaction, it has to be considered a gift for Medicaid purposes. Your person creating the trust and giving the assets has to give up significant control so that it's considered a gift and no longer under their ownership or control. We'll talk in pretty good detail later on about who should be the trustee. We'll also talk about a little bit about principal beneficiaries. So I always break down these trusts into two time frames. There's going to be during the lifetime of the settlor or settlors, and then after their death. And the beneficiaries during lifetime may be different than those upon death. And in fact, that's very, very common. So just to review one of the primary ideas behind these trusts, because they're irrevocable, because your client typically, and who is typically the Medicaid applicant in the future, because they've given up control of an asset that was once theirs, we need a sort of an escape hatch if we do need some money out of that asset. And so that's why you'll have lifetime beneficiaries, beneficiaries during the lifetime of the settlor. Those are people who are able to receive funds from this trust during the lifetime. So if we do need money out of these trusts, it can't go to your client or the settlor, but it can go to those beneficiaries. So those are going to be trusted children or grandchildren or other close people to your client who can be trusted to take that distribution from the irrevocable trust and know what they are technically really supposed to do with it, which is go pay bills or expenses or debts of your client, or maybe they will be returning that money back to the client to pay for those items that they need. So that's why you have specific lifetime beneficiaries who really kind of understand what their role is in this trust. Now, as soon as your client adds a piece of property to this irrevocable trust, it begins a 5-year clock. And that's because the Medicaid application says, hey, applicant, what have you given away in the last 5 years? And if that client can say, well, I haven't given anything away in the last 60 months, I gave something away 61 months or 62 months ago or 6 years ago, then they can confidently answer that question. I haven't given anything away in the last 5 years. So now, and that is for each addition to the trust. So if your client makes an addition with a deed on the day that they sign their irrevocable trust, and then they subsequently make a distribution of, let's say, investment or cash assets later on, maybe it's simply a month later, but maybe it's several months later, each of those assets now has their own 5-year clock. The other thing that these irrevocable trusts do a really great job of is it just provides more protection for those beneficiaries during the lifetime of the settlor and after the death of the settlor, because depending on how you craft it, you can quite easily give these funds to a child or some other beneficiary in a protective trust, and that protects against your 4 Ds, which are debt, divorce, death, and disability of that beneficiary. So if that beneficiary dies, your client knows where these assets are supposed to go in that instance. If your client gets to, if the beneficiary gets divorced, your client knows where the assets will go and that they will be protected in the event of the divorce and stay within the bloodline, if that's their choice. So the biggest takeaway here about these trusts, again, just reviewing the basics for you, is your whole goal is to make sure this trust is structured so that the assets are considered unavailable or not available assets when your client goes to apply for Medicaid after at least 5 years has passed. One of the big choices that you will make as the drafter of these trusts is regarding the income coming out of these trusts. So you can create an income only trust, or you can be very restrictive and have no income coming from these trusts. So when you're making this choice, it's really, really important that you understand your state's or your client's state's Medicaid rules, to understand that upon an application for Medicaid, how is the Medicaid agency going to look at these trusts? And if there is an income stream coming out, is the income stream the only thing that will be counted? And is that an acceptable outcome for your client? Or because income is coming out, is your Medicaid agency now going to count the entire corpus of that trust as being available to the settlor? So when we start talking about real estate going in, especially if it's a primary residence, or in Missouri and Kansas, we have a lot of farm land that goes in that may be income producing. So we start to look at what income is being produced and what does your client want to do with that income. So for example, rental property that generates income, that then has a choice whether the income from that rent is mandatory to be distributed out to your client. A lot of clients may put an asset in there and they rely on that income for their daily expenses. And even if they need Medicaid, if your state only counts the income stream and you say, all right, well, the income stream, pops out this income as it's earned, then if that's an okay outcome for your client, where they go into the nursing home, they've got their Social Security income and the income from this irrevocable trust, if they're okay with that being counted as their income that goes towards their payment to the nursing home. In Kansas, we call it a patient obligation. In Missouri, we call it patient liability. So if that's an okay outcome to your client because they got the income in the 5 or more years prior, that might be just fine. Now, you can also be very restrictive and say there's no income coming out of this trust. The downside there is that if it's accumulated inside of the trust, then it's going to be taxed to the trust at the trust rates. So Mark, do you want to talk a little bit about the tax ramifications and take us into a little bit deeper detail here?
Sure, I can do that. So the income only side of the ledger, there's, you have this consideration when you have these types of trusts is the distribution of income mandatory, or you'll see that there's, it could be accumulated. On the Medicaid side, the problem is that if income could be distributed but isn't, generally that means it gets added to principal. And if it gets added to principal, then it can't be distributed anymore, because there's always going to be a restriction on the distribution of principal, because that's how you protect the asset. And so if that occurs, then you have to consider a 5-year issue, because you could have received the income and now you can't because it's been converted to principal. So so that's something to be mindful of. And so if I do draft an income only trust, I just tend to make it mandatory rather than discretionary, because you'd get into the issue of perhaps not distributing income, and then you have a 5-year issue. The other issue that you get into, the income only part means, really the word income means income for trust accounting purposes. It doesn't mean income for income tax purposes. So the interplay there is capital gains. Capital gains are that's income for income tax purposes, and you have to pay capital gain income tax on capital gains. But capital gains are generally allocable to principal for trust accounting purposes. And so if you have an income only trust and there's a sale of real estate, for example, appreciated real estate, that capital gain gets allocated to the trust. And if you're relying on the income only portion to create this grantor trust status that we've talked about, then that capital gain will not be grantor trust, but will be non-grantor trust, and the trust will have to recognize that capital gain at the trust level rather than at the grantor level. So there's lots of things to be mindful of here. I've kind of come to the conclusion, so I don't have too many people do income only trusts anymore, because I've kind of come to the conclusion that if you're going to do an income only trust, you kind of need a professional trustee involved, because it's hard for lawyers to keep track of the Principal and Income Act. And so I think a professional trustee that has software, they can properly keep track of principal and income and make sure that the right amount of income is distributed out. For example, capital gains should be allocated to principal. that should not be distributed out to a client. I mean, presumably that's not their intent anyway, but you do get into all these issues when you get into that. So most of my clients just choose to do the trust on the right, which I call a no income, no principal trust, because it's easier. The client's just not a beneficiary and they know that.
Yep, it does make it simple. Now, let's talk about a scenario where you have just a house, which happens to be the primary residence of your client in that trust. You're going to have choices to make, specifically about, is rent charged and how does that work? And that also plays into this income discussion as well. So just to go back a little bit, since the home for many of our clients is oftentimes their largest asset, when the deed is executed to transfer that asset into the trust, that begins a 5-year look back on that asset. Now, your settlors still live there. So you're going to have a couple of choices to make once you know that their primary residence is going in the trust and they plan to continue living there. At least until they enter long-term care, right? So you can choose to either retain in the trust language the right for your client to use that property, or alternatively, you can say no right to use the property or be silent on the matter, and then have a lease agreement. So we're going to talk a little bit about that choice and how that works. And then, of course, if you have a lease agreement, do you charge rent and how does that work as well? Okay, so if you put in the trust document a provision where your client retains the right to use their property, sometimes your settlor feels comfort in that because they can't get kicked out of their home. The trustee can't all of a sudden say, I'm sorry, we're going to sell this asset and now you have to leave, because the trustee has that right when you do these. Now, question, would you give an exclusive right for just your client to retain the right to use the property? Now, if you have that right reserved in there, will the Medicaid agency view your that right as now making that residence or even the entire asset preservation trust an available resource? You've got to know how your state Medicaid agency is going to count that retained right to use the property. So you would do this by putting a specific clause in the trust document. And one important question is, does your state review the asset preservation trusts? So for example, in the 2 states where I work in, both of them have a question on the application that says to the Medicaid applicant, are you a grantor, settlor, establisher, or a beneficiary of any trust? And so the answer to that is yes. And when you say yes, then we in Kansas and Missouri have to provide a copy of that trust and disclose that. Now, if your state doesn't ask about it at all and they just say, have you given anything away in 5 years? And you can say no. Well, then maybe your state doesn't need to review these, and maybe they would never catch a retained right to use the property. Mark, do you want to talk about what happens when you don't retain that right?
So if you don't retain the right to occupy, presumably your clients aren't ready to live somewhere else, so they want to continue to live in their home even though they don't own it anymore. So, a common thing that we need to, kind of re-educate clients on is you don't need to own real estate to be able to use it. You don't need to own real estate to be able to live there. And, that goes back to when many of us were younger and there's a landlord-tenant situation. So if this trust owns the real estate, and then the trustee could be viewed as a landlord, and your your client can be viewed as a tenant. And so then what does rent really look like? Well, that's really between your client and the trustee of the trust, whoever that is. But in many cases, it can look like, real estate taxes, homeowners insurance, utilities, maintenance, upkeep, repairs, and say that's the rent I'm going to pay. And so the value of that is clients are going to pay that stuff whether they own the house or not. So they're willing to continue to pay for it. But in this structure, they don't own the home, so that if they do need long-term care in the future and they don't have insurance for that, if they get through the 5 years, the home is outside that look back period, and they don't have to worry about the home being part of Medicaid eligibility.
Yeah, so Mark, can you talk about a case where the residence trust owns the house and then the client does actually pay rent to the trust? How would you handle that to make sure that everybody's on the same page about who's doing what, who's on first?
Yep. So we enter into, and it's not exotic, it's not 20 pages, it's actually 1 page. But we do enter, we have the clients enter into a lease agreement. The trustee is acting as landlord and the client is as acting as tenant. And usually I call it a break-even lease, where the client is going to pay, or agrees that the rent is those items, taxes, insurance, upkeep, utilities, repairs, maintenance. Clients are more than willing to do that because they're going to do it anyway if they own it. So they're not really paying anything more. I do have some, enterprising clients who will say, well, what if I pay those things, and on top of that, I pay $1,000 a month to the trust? Well, you're always going to get into, you got to have to be mindful of fair market value rent, because clients might say, well, then why don't I pay $50,000 a month rent? Well, then you're going to get into a part rent, part gift situation, and you're going to be facing all the look back and penalty period rules. But if it's fair market value rent, so let's say it's all these things, taxes, insurance, utilities, repairs, maintenance, and $1,000 on top of that per month. If that may very well be fair market value rent. How do you establish that? Well, get somebody who's familiar with rentals in your area and provide an opinion that that's fair market value rent. If that's the case, then that $1,000 from the client to the trust should not be a gift to the trust, because it's part of an obligation. To live in the house, you have to pay the taxes and insurance, but you also have to pay this $1,000 a month. If that is, within the realm of reasonable fair market value, that's not a gift to the trust. That's a legal obligation that they have to live there. So
it's kind of a way to add assets over time, but not restart your 5-year clock.
I mean, if you use that simple, that's exactly right, Maureen. If you use that simple example, $1,000 a month is $12,000 a year. Over the 5-year look back, that's $60,000 extra that could be added to the trust, and there should be no gifting, look back, or penalties on that, because it's not a gift. The client owes it in order to live there.
And then I think what you're saying too is that fair market value number that you can establish by finding some, reasonable evidence, that's your ceiling. Now, what if the upkeep, maintenance, taxes, utilities are less than the fair market value of rent? And do you go into detail of establishing fair market value rent on every trust?
I think less than fair market value, you're not going to get in trouble with. through Medicaid, it's only if you're over. So if you use the example of $50,000 a month for rent and fair market value is only $2,000, okay? 2,000 is fine, 48,000 is a gift, and you're gonna face look back and penalty period or obligations on that. If fair market value is 2,000 a month and you're only paying $1,800 a month, I don't think there's a problem there.
I would agree. It looks like here too as well, it's important to state in that lease that it is renewable, or that your client has the right to lease that property until they choose to vacate the property, and also the ability to amend it. So as Mark has illustrated, if fair market value of rent increases in the area where this home is located, your client may want to increase that rent over time and be able to add rent value to the trust. Maybe the trust starts to take over paying for the upkeep, maintenance, and things instead of your client if they start to have cognitive issues and need the trustee to take over those. So, I think the ability to amend those lease agreements is really important. So Mark, when your client is paying some amount of rent to the trust every month, then how does that affect whatever you have put into your trust as the income provision? So can you walk us through if it's an income only trust versus if there's no income?
Well, at least on the rent side, I mean, I think that's, part of, it's a good consideration, but I think that's part of the reason you kind of want to make a lease break even, so to speak, because what's the, so let's just say all these costs, taxes, insurance, upkeep, utilities, let's just all say that's $1,000 a month, $12,000 a year. But you say, okay, but we're going to charge you that stuff plus $1,000 a month in rent. Well, now your client's going to pay that, but then they're just going to get it back because it's an irrevocable income only trust, and I think that would be kind of silly. So, if you're going to do that, I think it's a lot easier just to say, why don't you make it no income, no principal, and they can keep that $1,000 and just have the break-even lease.
Okay, fantastic. All right, now let's talk about choosing a trustee, because I don't know about you, Mark, but this is one of the most important conversations that I think I have with clients when I am working with them on this project. So should you make the settlor a trustee, or should you have a non-settlor as the trustee? And in all of my consultations with clients, when I'm describing these trusts, at least in Kansas and Missouri, I am telling them that they may not be the trustee, because in both states where I work, the state sees that as too much control over the trust assets. So in my states, I'm never allowing my settlor to be trustee. Now, that your state may have, other rules, but generally there's not statutes or case law that really state whether your client can be the trustee. So now, if they are the trustee, it's advisable from us that that trustee does not receive compensation for being the trustee, and that they also are not allowed to receive reimbursement for expenses. Okay, so now if your settlor is the trustee, of course, they're not going to be able to distribute to themselves. They can still only distribute to the lifetime beneficiaries. And so they may be able to make discretionary principal distributions. Now, when your settlor is the trustee, they have enough control over those assets where those distributions are included in your client's gross estate for federal estate tax purposes. So keep that in mind, depending on your client's level of wealth and the current estate tax limit, and whether or not your settlor as trustee is a good idea from an estate tax perspective. Now, if you have a non-settlor as the trustee, it should be expressly stated in the agreement that the settlor cannot serve as trustee ever. Now, should you give your settlor the right to remove or replace the trustee? And in my case, I typically do give them that right. But I say who they're allowed to replace it with, and of course it's not themselves. Now, you should also consider, should the settlor retain the right to remove and replace, but with or without cause? And you really have to know whether just that right alone held by the settlor is enough for your state Medicaid agency to say, sorry, that's too much control that can be exercised by the settlor to change their trustee, because presumably they could have a back end deal with the person that they install as the new trustee. And so the Medicaid agency says, sorry, that's just too much control. So sometimes you can say, yes, they can remove and they can replace, but when they replace the trustee, it has to be an independent trustee. And that, to most state agencies, at least the ones that I work in, if they can replace with only an independent trustee, it cuts off that argument by the state that they can have a back end deal with the trustee. So our states allow for that. Mark, any commentary here?
No, just I'd say make sure, if you're going to do these, know how your states, handle Medicaid applications and what information they're looking for. Wisconsin is a little more generous than Missouri and Kansas, and so we only have to worry about disclosing, I just call them 5-year trusts, but we only have to worry about disclosing 5-year trusts if the client is a beneficiary. So if it's that irrevocable income only trust, okay, we're going to have to identify that the client's a beneficiary, and that may require having to show, the trust document and trust records. But other than that, the state really has no other questions on its application, so it makes it a little bit easier for us to navigate that.
I will also say there was a fantastic NAILA presentation about the choice of trustee in these irrevocable trust contexts. So there is some material out there in the world that talks in great detail about this. But generally, when I'm counseling a client on choice of trustee in this 5-year trust context, almost always we are choosing a family member over a corporate trustee. And that's typically because my clients don't have complex tax issues that we're dealing with when we use these kinds of trusts. Because the purpose is not necessarily tax protection, it's typically Medicaid protection. So we're treating these, or they really have a different goal. So we don't necessarily need the technical assistance of a corporate trustee. And then when we have a family member, they understand the intention behind the trust, which is really to protect the assets for the future after the settlor's death. And so because they know that, and because they knew that from the start, then typically they're going to honor that intention, even if there's a beneficiary saying, hey, trustee, you have the power to distribute to me, so I'd like a distribution. If your trustee knows that that's really not the intention behind the trust, oftentimes they're not going to then make a distribution, even if the trust allows it. So, do you want a child of the settlor to be the trustee, or do you want a non-child to be the trustee? Mark, do you want to talk a little bit about this?
Sure. So if you have a child as the trustee, being a trustee gets you into, tax world a little bit. And so if you're a child trustee and you have this ability to distribute trust assets for any reason, any purpose, and it's as broad as can be, that child's going to be deemed to possess and hold a general power of appointment, assuming the child is one of the people that can receive, can make a distribution to himself or herself. So we call that a trustee beneficiary. And if the child is a trustee beneficiary and has unfettered power to make distributions to himself or herself that is not limited in any way, shape, or form, that child's going to be deemed to hold a general power of appointment. So that's where you can make a distribution to yourself, your creditors, your estate, or the creditors of your estate. Well, here it's to yourself. And in effect, that means you own the assets. And so if you die holding that power, those assets are in your estate for estate tax purposes. If you make a distribution to your sibling and you're that trustee beneficiary, that's a gift for gift tax purposes. So it's just quirky little things to be aware of. But if that child who is a trustee beneficiary is limited to something like, maintenance, health, education, maintenance, support, that's the ascertainable standard, then they're not deemed to hold a general power of appointment, and there's no gift and estate tax issues for the child when they make distributions. So if it's not a child, then, okay, the client may have some concerns that how can I, if it's not a child and I can control the child, how do I control the bank, right? Well, and then there's these, design questions that you could put into the trust, perhaps, depending on your state. But, is it okay for the settlor to be in charge of investments? I don't know, respectfully, I don't know how choosing stocks and bonds has anything to do with making assets available for Medicaid. I mean, all you could do is choose stocks and bonds. That doesn't mean you're a beneficiary. Now, at the same time, if you could choose stocks and bonds and you're an income beneficiary, then it matters, because you could make more income or less income depending on your investments. So you have to be mindful of that. And if you have an income only trust, you probably don't want the settlor to be controlling the investments too much, because Medicaid is just going to say, well, make it income producing to the greatest extent possible, because then that patient liability will be less. So then can the settlor, what about distributions? Maybe there's a corporate trustee and the only beneficiaries are children or grandchildren, but maybe the settlor can have a veto power, so that, if the corporate trustee says, well, I'm going to send money to the settlor's daughter, Maureen, well, maybe the settlor could say, but I'm going to veto that, so it can't happen. I mean, maybe that's a power that's okay, that won't cause the assets to be treated as available for Medicaid. Again, you have to look at your own state rules. But these are all sorts of things that we can do with trusts. We can get fancy. The question is, are you going to get too fancy to cause these assets to be available? And then if that's the case, should you even be doing the trust in the first place? Because the client's not achieving this important goal of getting their assets in effect out of their name for purposes of Medicaid eligibility.
Excellent. All right. So now we're going to get into that, what I feel like gets into the really deep dive territory. So we're going to talk a little bit about the retained testamentary limited power of appointment. So what we're essentially trying to do here is give what I think of in my mind. I'm a really visual learner, and so in order for me to retain these concepts, and especially to be able to talk to clients about them, I think of this as the installation of a hook, right? And this is a tax hook in my mind. So when I think about this, and how I explain it to clients is, The grantor, if they get upset with their children and they want to change the distribution amongst the beneficiaries, the eventual beneficiaries, that they still have the power to do that. For example, if they have 3 kids, and right now the trust says that the 3 kids get equal shares, but in the future they want one child to receive a much smaller share and the other 2 children to receive a larger share, they retain the power to do that. And simply by retaining this limited testamentary power of appointment, you have now established a tax hook that provides for a step up in basis for federal income tax purposes. So especially when we're thinking about residence trusts, this is an extraordinarily important hook to install. So for example, my client has purchased a cute little ranch home in Prairie Village, Kansas, and when they bought it, they paid $40,000. Well, now one sliver of that property is worth $40,000 and it's probably worth $400,000, right? So that is a huge gain in value over time of that property. And so if my client does not retain the step up in basis, then when the children eventually inherit that property from this trust, they're stuck with mom and dad's tax basis of $40,000 and they have to pay tax on that entire huge, enormous gain. So installing this hook and getting them the step up in basis so that when the children inherit the property, their tax basis is the date of death value. That is extraordinarily important. So you want to make sure you install this hook. Any additional thoughts there, Mark?
Yeah. So I one of our jobs, whether we like it or not, is to always convey value and why they should hire us. So take Maureen's example. And so $400,000 house with $40,000 basis, that's $360,000 of gain. And the current top capital gains rate is 20%. So it's kind of unfortunately, you could just say, well, okay, if it's $360,000, 10% of that is 360 or 36,000. So 20% is $72,000. So the federal income tax on that gain would be $72,000 if there was no step up in basis. The kids inherit it and they have to sell it. Right? So $72,000 of gain, that's not counting state income tax if your state has one. And you could say, well, but we're going to eliminate that. So $72,000 of tax savings is part of this plan that we're putting together. So it's not just protecting it from the nursing home, we're also protecting it from possible capital gains tax if you're should your mother pass away still owning the house. Well, your fee's not going to be $72,000, I'm guessing, but that's value in real numbers that you can convey by saying, because of the way we're going to structure the trust, though, if the house is still owned at death and then you kids sell it, you're going to have more money in your pocket. And that's a value. And
yep.
It's quantifiable, it's easy. So, try to figure out what the basis is, try to figure out what the fair market value is, and use that to your advantage when selling your services.
Absolutely. So of course, if your client retains it personally, you most likely get the step up in basis, but because they're giving it away to this trust, you have to install the hook to make sure they get the step up in basis. However, you want to make sure it's limited, because we don't want the very entities that we're trying to protect from, AKA Medicaid and estate recovery, to be able to say, oh, you can exercise out of power of appointment and give us some of this trust property upon your death. So you want to expressly prohibit those very entities from being able to receive any property pursuant to the power of appointment.
In other words, don't make it a general power of appointment, make it a limited one.
That's right. Okay. Hey, look at there. We just talked about step up basis. So in the interest of time, I am going to skip this slide, but the information is there. All right. Mark, we've talked quite a bit about this. I think this is a really helpful chart that you might be able to keep at your desk or nearby as you're drafting these things to kind of wrap your head around completed gifts versus incompleted gifts and the estate tax implications and gift tax implications, so that as you're crafting and designing these, you can refer to this chart and say, okay, here I've created a completed gift scenario when distributions are made or before distributions are made. And so what does that do for estate tax? What does that do for gift tax? And really think through each of these design choices. I'm not going to go into detail since we have touched on a lot of this, unless Mark, you have any comments that you want to highlight on this slide.
I think generally speaking, your goal is planning in this space is to have a completed gift for Medicaid purposes and an incomplete gift for gift tax purposes. And so I kind of call that splitting legal hairs. And if you could articulate that to clients, you're showing your value, makes it easier for them to hire you.
Absolutely. And it's funny that you say that. I oftentimes will tell clients, right now, the topic we're talking about, we're in Medicaid world. And so we're subject to Medicaid rules, because clients, of course, think all the time, oh, I can give $19,000 away, no problem. There's no penalty for that. And you tell them, oh, yes, that's when you're in tax world or in IRS world. We're in Medicaid world. That is a problem. So if you can sort of do that while you're drafting or while you're explaining these concepts to clients as well, you know, this provision is in here, or let's design this provision with estate tax in mind. Let's design this provision with gift tax in mind. Let's design it with Medicaid rules in mind. That will help you design these trusts as you go.
And it conveys to the client your value.
Sure does. Yeah, absolutely. Okay, so as you're drafting and you've installed the hook for the limited testamentary, oh, I've got limited in there twice. See, we're very limiting around here. Limit, 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 that power of appointment. It may not be enough to give you income tax see-through. So what I mean by that is that if you want your client, the settlor or grantor of this trust, to pay the income tax on the trust assets, because a lot of my clients have this concern. They say, okay, well, yes, I want the protection, but I don't want my kids to be burdened with now paying tax. Plus, those kids are in their high earning years. We don't want to pay tax at their income tax limit, nor do we really want to pay income tax at the trust level, because that's a compressed tax bracket. I want to keep paying yeah, exactly. I want to keep paying the income tax on these assets that I still consider mine, that I'm giving up for these, you know, protection reasons. So just giving that limited testamentary power of appointment might not be enough to give you flow through tax status for a grantor. So Mark, can you talk a little bit about maybe some additional hooks that you can install to get income tax to flow through to your client?
And you're always going to have to make sure, again, in your state, what the rules are, how they're interpreting the rules, and how they're applying the rules, so that you don't create availability. Generally, as Maureen said, what you're wanting to do, though, is to create grantor trust status. Your client is the grantor, because they're the ones granting or establishing the trust. And if a trust is a grantor trust for income tax purposes, what it means for income tax purposes is that they're deemed to still own the assets and the income from those assets. So again, it's this legal fiction, if you will, that for property law, for Medicaid law, your client does not own the assets and does not own the income from those assets. The trust does. But for income tax purposes, if there are certain powers drafted into the trust that the client retains, the trust can be a grantor trust for income tax purposes, where the client is deemed to own the assets and the income from those assets for income tax purposes only. So how do you create that? Well, on the slide here, we have section 674, which is, about controlling the beneficial enjoyment of trust assets. So we've got, the power to allocate amongst charitable beneficiaries, or that's in 674. Section 675 is another section to create grantor trust status. Why do you want to be mindful of this? Is because of the difference between individual tax brackets and trust tax brackets. If a trust is a non-grantor trust, so that the trust is treated as the owner of all the income, after $16,000 of trust income, you're at 37%. An individual doesn't reach the 37% tax bracket until $600,000 of income. So you really, chances are you're going to want the income from the trust to be taxed at the grantor level rather than at the trust level. So it's going to be important from a design and drafting standpoint that you're probably going to want to create grantor trust status so that this income can be at more favorable tax brackets, because trust tax brackets are as bad as we can have.
Yep. And so the reason that we discuss just these two, because there are a lot of other ways that you can get that grantor trust status for income tax purposes, but many of them would open the door to Medicaid saying, hey, that's an available resource if those powers are held by your client. So we provided you with what Mark and I think are your better options or good options, which are these two powers that don't provide your client with so much control that Medicaid would now say that's too much control and you own it for Medicaid purposes. All right. We are quickly running out of time. So we talked quite a bit about renting from the trust to the client on break-even terms. So let's touch on the homeowner's exclusion really quickly. But basically the point here is that if you can draft the trust to maintain the section 121 exclusion, then if the home is sold during your client's lifetime, they also get the benefit of that tax exemption.
And that's just making sure the trust is a grantor trust for income tax purposes, because then they're still treated as owning the home for income tax purposes. If it's a non-grantor trust, they're not treated as owning the home. The trust is, and you don't get that homeowner's exclusion. So that's another important reason that if we're talking residence trusts and you're putting a homestead into the trust, you probably want to make it a grantor trust so that if the home is sold during the client's lifetime, this section 121 homeowner's exclusion is still available.
Yep. All right. I think this one is extremely important, and I'm starting to run into it more and more. Mark, can you talk about what happens when the piece of property that the client wants to put into the trust, when it has a mortgage on it? They're giving it away. So yep, the mortgage companies start to get nervous?
Very nervous. And in fact, there's probably somewhere in the 30-page of small print mortgage document, there's probably a provision about that prohibits the transfer of assets. Fortunately, if it's a residential property that your client lives in, there's a way to deal with that. So, if you go back to the pandemic, interest rates got to be very, 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 very low. A lot of people took advantage of that, and they would hate to lose it by transferring their homestead to an irrevocable trust. But their lender's going to say, well, too bad. You're transferring it to a new owner because your trust is a new owner. So we're going to call it all due and we're going to refinance your debt at this higher interest rate. And so your client's not going to want that. So what can we do to avoid that? Well, there's a federal law, the Garn-St. Germain law, and if your client retains certain rights, this is where it gets tricky with Medicaid, this federal law would prohibit a lender from calling the loan due.
And so we want to make sure we can take advantage of that law.
We do. So it's A, you have to be aware of it, and then B, you can draft around it. It's not easy. I've taken a stab at it, but basically it's a occupancy right that cannot be sold, transferred, assigned, or if you think about these Medicaid compliant annuities, which you would be familiar with what Ashburn does, the concept is similar, and that, it has no economic value. And if it has no economic value, even if they call it an available asset, fine, it's worth zero. So who cares? Because I can't, if you put in there, you can't sell it, you can't transfer it, you can't negotiate it, you can't do anything with it. It's going to be subject to the 5-year, gifting rules, but you're gifting the real estate anyway. You're already planning on that. So what you're retaining is pretty much worthless.
Yep. So we've provided you with a handout that has some ideas for the specific language that you can put in the trust agreement and in the deed for the real estate to take advantage of that Garn-St. Germain Act rule. And then we again recommend that you have a lease agreement that again reiterates that that right can't be assigned and that it can't be sublet either. All right, we've talked a lot about these practical issues, making sure that homeowners insurance stays valid because that's technically a responsibility for the trustee. So making sure that the parties understand who is responsible for that. And also, should there be renter's insurance that is now added on to the homeowner's insurance now that you've changed owners? And then property taxes, making sure those are paid, and that responsibility typically lies with the trustee. So are you giving that to another party? And just making sure that all of these are spelled out in the plan.
And for note takers, if you go back to that one slide, Maureen, I'll only spend 10 seconds. But if you are transferring a property that is subject to a mortgage or a home equity line of credit into the trust, maybe that rental agreement needs to also include mortgage payments, and that the tenant is not only responsible for all these items listed here, but is also required to pay any mortgage payments that are due every month, and build that into the lease as well.
Fantastic. So I don't see any questions typed into the question box. Stuart, do you know if we have any questions? If not,
yes,
we're open for questions.
Awesome. Yeah, I was just going to ask because it does appear that we did have 4 questions that came in. So if you have a couple of minutes, I'd be happy to read them off and then see what we can help answer. So first question is, when you include a testamentary limited power of appointment, doesn't that then require that the last will be probated? And then does the home go through probate so that the step up in basis occurs? And if so, because of the capital gains savings, I anticipate the switch to probate still makes sense, correct?
I think I'll tackle that one first, and then Maureen can answer. But I think that'll be a state by state issue. In the sense of a retained testamentary limited power of appointment, it all depends on the language that you include to say, can it be exercised by will, by codicil, by revocable trust, amendment to trust, or even by a notarized, document. So the question is how can it be exercised? To take effect at death. That's what really testamentary means. So whether it would really need to go through probate or not, I think it's a state by state issue, but I would also look at how it could be exercised. That would kind of be my comment. Read it one more time again, Stuart, because I think there was something else.
Yeah, and I'll just jump in real quick too. So I think it depends on how it's exercised, but typically, I wouldn't necessarily have the house then pulled into probate. It would simply be a matter of that exercise potentially changing the distribution pattern in the trust, but that doesn't necessarily mean that the asset gets pulled into probate court.
You don't need to read it back. Now I know what I was going to say, Stuart, is that what creates stepped up basis, I mean, is pretty well settled law, is as long as an asset would be included in your gross estate for federal estate tax purposes. Your gross estate can be much, much more than just your probate estate. So the retained testamentary limited power of appointment is going to cause that whatever assets are subject to that power is going to be in the decedent's gross estate for estate tax purposes, and that's what provides stepped up basis under the code. So probate's not necessary for stepped up basis.
All right, thank you for that. The second question is, if the residence is sold during lifetime of a settler, normally because the settler goes to nursing home after 5 years, can you explain how IRS Section 121 applies? How do you handle at closing to keep from a 1099 to be issued to tax ID of settler?
You want to go, Maureen, or I'm happy to go.
Go ahead.
So, a lot of times there just needs to be education. I mean, a title company, a real estate agent, they're never going to know the intricacies of the trusts that you draft. They're never going to know it. And so, what you need, even if a 1099 is generated, even if it's generated in the name of the trust, a trustee has a duty to do what I call an informational return. And clients, sometimes they'll say, well, I have to do an informational trust tax return. Yeah, and that might cost you $500 when that's what it costs to be in the nursing home for a day. So don't always remember the big picture. But, I don't worry about these things. I mean, if a 1099 is going to be generated, that's great. I mean, because you deal with it on the return. Now, if you can deal with it, I mean, most times we draft a trust and we're not necessarily going to be called to say, hey, can you work with the title company to make sure no 1099-S for sales proceeds is generated? I mean, sure, if you get in advance, then you could work with the title company and the realtors, but they're probably not going to understand the legal fiction of grantor trust status. And so the key is really on the reporting side. Even if I had a client who just sold it in their own name and got it, you're still going to report it and use the homeowner's exclusion for it.
Yeah, and so maybe what the question asker is concerned about too, because I'm seeing this more in our states where the state Medicaid agency is using tax return data to do annual renewals. And so if that data is flowing through and now the Medicaid agency has a problem with the sale of the house, I do see where that can cause then some confusion. So you may be asked then by your client to go explain to the Medicaid agency that this house was in this asset protection trust. It was not owned by the grantor and by the Medicaid applicant. And so it may be an instance where you just have to know then how to work with your Medicaid agency on the back end if something like that did occur.
Awesome. All right, so question number 3 is, what are the considerations for a reverse mortgage in irrevocable transfers?
Wow, that's a great question.
I think hard, because, you know, and that's something you need to talk with clients about, because generally reverse mortgage is going to say that as soon as the mortgagor, the client, either leaves the home or dies, the debt is due. And I've not seen a mortgage, so usually they want the mortgager to be the client, not an irrevocable trust. And so challenging. That.
Yeah, and
It's just something they might have to give up if that's what they're wanting to do. They might not be able to do the irrevocable trust if they're wanting a reverse mortgage, because I've not seen it yet.
yep, agreed.
All right, and then the last question that we have is, you mentioned earlier the potential for the trustee to begin making payments for the home if the settlor no longer can. Would that cause issues with the availability of trust resources to benefit the settlor under the any circumstances rule? And does it change at all if or when the client goes into a long-term care facility?
Let's break that down a little bit. So, okay, so in this scenario, now our client and settlor of the trust has now gone into a care facility, and the trust is taking over the responsibility of paying for all of the property taxes, homeowners insurance, all those good things. I think the question is getting at, now we've just reassigned maybe the use of some of the liquid resources inside of that trust. And instead of being able to be used for care expenses, as maybe was one of the hidden intentions behind these trusts, it now has to go to pay for the property costs. So if a client comes to me with these questions, I'm breaking down for them, how much liquidity do we have? What should that liquidity be used for? What is it needing to be used for? And do we still need this property? Because if no one's living there, oftentimes it makes way more sense to sell it. And now we have a lot of liquidity. For example, if we haven't gotten past that 5-year look back yet, and client's not ready to be on Medicaid, and they may need now the assets that are inside that irrevocable trust. Remember, we can't give the assets directly to our client, so we have to go in the roundabout way. So that's why I just want to kind of parse that question a little bit. You can't assume that the assets will be used for the settlor's care expenses, because the trust specifically prohibits that. That's why you've got to have your lifetime beneficiaries who know the drill, who are going to get the money, turn around and use it for mom's care expenses, at least until the 5-year look back is up.
Right. And I'll just add some thoughts to that. If there is a lease agreement between trust and client, you probably want to get that canceled. And then for certain expenses, really for almost all the expenses, it really is the trust's responsibility. The real estate taxes will probably be coming in the name of the trust. The homeowner's insurance probably should be in the name of the trust. So if the place burns down, the trust gets all the money, not the client. And so those are really trust expenses. So just like paying a trustee's fee, the trust can pay those, and that's not an issue. It's just, if the client's living in the home, you'd rather have the client pay those and save, let the money in the trust be growing and invested and not have to be used for real estate holding costs. But so that's why you'd want to cancel that lease. But if there are no, if no kids are going to be living in the property, and then as Maureen suggested, you might want to be looking at selling the property so you don't have those holding costs for too long, because real estate's an expensive asset to own compared to a brokerage account or a bank savings account. But I do think a trust can pay those expenses for real estate that it owns, no problem, because if it doesn't, it's going to go to a tax sale, and that's not in the best interest of the trust beneficiaries.
Great
Awesome.
questions, everybody.
Yep, those are really great questions. And I want to thank you, Maureen and Mark, again for your time and sharing your expertise with us today. Very much appreciated. And then finally, as a reminder to everybody, a copy of the presentation will be available later in the week for you to watch at your convenience. If you have any additional questions that come up after this presentation, just feel free to reach out and we can get those answered for you. And lastly, just oh, come on, Mark.
And I'll ask Mark the answer.
I will get it to the right person for sure.
We're both good.
Yeah. Again, lastly, just keep a lookout for our next webinar, which will actually be next week, where Amber Hines and Todd Watley, attorney Todd Watley, will be talking about planning for IRAs and Medicaid planning. So again, thank you, Maureen and Mark, and thank you everyone else for attending today's webinar. Hope you have a wonderful day.
Thanks for having us.
Bye.
Bye-bye.